Supply and demand, the invisible force guiding your investments. Imagine a bustling marketplace. Vendors hawk their wares, their voices competing for attention. Customers browse, some eagerly clutching their shopping lists, others meticulously examining the quality of goods. This simple scene embodies the fundamental principle of economics: supply and demand. The engine of the market. Supply and demand represent a beautiful dance. Supply refers to the quantity of a good or service available for purchase. On the other hand, demand reflects how much people desire that good or service and how much they are willing to pay for it. Think of a popular new gadget. Initially, the supply might be limited, driving the price up as customers clamor to get their hands on it. This is high demand, low supply. However, as more manufacturers enter the market, the supply increases, leading to a potential price decrease as competition grows. This is low demand, high supply. Why does this matter to stock investors? Understanding the forces of supply and demand is crucial for stock investors. Here is why. Stock prices. Imagine a company exceeding earnings expectations. This positive news might attract more investors, pushing up demand for the stock and consequently, the price. Conversely, negative news could trigger a sell-off, increasing supply and driving the price down. Industry trends. Certain industries might experience fluctuations in supply and demand over time. A surge in demand for electric vehicles, for example, would impact companies in that sector. Investors who understand these trends can identify potential opportunities. Economic conditions. Economic downturns typically lead to decreased demand across various sectors, potentially impacting stock prices. Conversely, periods of economic growth often see increased demand, which can benefit certain companies. Beyond the basics, a deeper dive. While supply and demand form the foundation, the real world is more nuanced. Here are some additional factors to consider that can influence the delicate dance of supply and demand. Competition. The number of competitors offering similar products or services can affect a company's ability to sell its own, impacting stock prices. Imagine a company with a revolutionary new drug. Initially, they might enjoy high demand with little competition. However, if other pharmaceutical companies develop similar drugs, the competition will drive down prices and potentially the company's stock price. Government regulations. Regulations or subsidies can influence the supply or demand for specific goods or services, indirectly affecting related stocks. For example, government subsidies for solar energy could increase the supply of solar panels, driving down prices and potentially benefiting companies that manufacture solar power equipment. Consumer preferences. A shift in consumer preferences towards sustainable or ethical products can impact the demand for companies that cater to those preferences. A company that prioritizes eco-friendly practices might see a rise in stock price if consumer demand for sustainable products surges. Mastering the dance. How to leverage supply and demand. By incorporating supply and demand analysis into your investment strategy, you gain a valuable perspective. Here is how you can leverage this knowledge. Identify undervalued stocks. Look for companies with strong fundamentals operating in sectors with potential for future demand growth. Imagine a company developing a new, energy-efficient building material. If the construction industry embraces this innovation, the company could see a significant increase in demand for its product, potentially leading to a rise in stock price. Understand market sentiment. Gauge investor sentiment towards a particular industry or company to understand if the stock price reflects current or anticipated supply and demand dynamics. If there's a sudden drop in the stock price of a company with a solid track record, it's crucial to analyze whether this is due to a temporary oversupply of the company's product or a more fundamental shift in consumer preferences. Make informed decisions, don't be swayed by short-term fluctuations. Analyze whether a price drop is due to a temporary supply glut or a more fundamental shift in demand. For instance, a company might experience a short-term price dip due to a seasonal decrease in demand for its product. By understanding seasonal buying patterns, you can avoid panic selling and potentially capitalize on a buying opportunity. The takeaway: the forces of supply and demand are like an invisible hand guiding the market. By understanding their interplay and the additional factors that influence them, you can become a more informed investor, equipped to make strategic decisions and navigate the ever-changing market landscape. So, the next time you consider an investment, remember the bustling marketplace, a constant reminder of the fundamental principle that drives economies and shapes the world of stock investing.